everyone, Farhan here. So today you will solve question 6 from 2023 past exam. In this question, you will record the balance sheet adjustments by preparing the ledger accounts. You will also understand the accounting assumptions, which explains the treatment for balance sheet adjustments. So let's begin. Big Sports sells a range of sporting gear. It reports monthly. On 30 September 2023, the following items each required a balance sheet adjustment. Here you can see we are given list of transactions, and the first requirement of the question is to complete the ledger accounts provided at 30 September and also close and balance them. So let's look into the workings on the right hand side, starting with the first information that we have. On 15 August, Big Sports paid $30,200 rent, including GST, for the 3 months commencing 1 September. So if the prepaid rent, including GST, is $30,200. Why do we call it prepaid rent though? We call it prepaid rent because we have paid this rent on 15th of August, and this rent is supposed to be expensed starting September 1. So when we prepaid this rent initially, we prepaid this including GST, and we prepaid $30,200 in total. So if I want to find the prepaid rent excluding GST, I simply divide 30,200 with 1.1. This is because the GST rate is 10%. So if I was to reverse from GST including to GST excluding value, I have to divide the GST including value by 1.1. And on that basis, the prepaid rent excluding GST comes out to be $12,000. So we understand that this prepaid rent covers the 3 months starting 1st September. And the 3 months we're talking about are September, October, and November. We're preparing the balance sheet adjustments at 30 September, given that the business reports on a monthly basis. So from 1 September to 30 September, we have 1 month that has passed, which means the prepaid rent now needs to be expensed by 1 month, right? Because we have consumed the economic benefit that comes with this prepaid rent, and that economic benefit is equal to 1 month of rent expense that we have incurred. So how do we find that? So we divide 12,000 by 3, and that gives us $4,000 as the rent that we consume or expense or incur on a monthly basis. So how can we journalize this? So if I was to journalize this on 30 September, I'll debit rent expense by 4,000 and I'll credit prepaid rent expense by 4,000. So what is the logic? When we incur an expense, our expenses go up. And when expenses go up, they are debited. So we debit rent expense by 4,000. We have incurred this expense, which means we have consumed the economic benefit that comes from the prepaid rent, which is generally a current asset by default. All assets initially will be debited. When we consume the economic benefit from the prepaid rent, we are actually reducing the prepaid rent or the benefits that come with this prepaid rent. Therefore, the assets have to be reduced, and because we're reducing the assets, we have to credit it. So we debit rent expense by 4,000 and we credit prepaid rent expense by 4,000. Now, based on the journal entry, let's look into the effect on financial statements and have a better understanding. So when we are increasing expenses, what happens? Our profit goes down, right? And if we are crediting prepaid rent expense, this means that we are reducing the current assets, which means in the balance sheet, we have to show $8,000 as the balance for prepaid rent if we were to calculate it on 30 September. Make sense? So if the question asks you to prepare the balance sheet and you have the option to show the prepaid rent balance at 30 September within the current asset section, you would be showing 8,000, not 12,000, because $4,000 has already been expensed or incurred. All right. Now let's look into the ledger accounts that we are given. So the prepaid rent is a current asset account. We understand that. And all assets, when they increase, we debit them. When they decrease, we credit them. Also, by default, assets should always have an opening balance on the debit side when it comes to the ledger account. So this is the debit side and this is the credit side of a ledger account. So the opening balance is on the debit side on the 1st of September 2023, and that is $12,000. All right. We know that during the month ending 30 September 2023, we have consumed rent, which means we have incurred an expense, and the amount of rent expense we have incurred is 4,000. The reason we are showing the rent expense within the credit side of the ledger account is because this shows the reduction in economic benefits or the value of the asset that we have for prepaid rent. So once $4,000 has been expensed, the closing balance at 30 September 2023 is going to be $8,000. And this was derived based on $12,000 being the total on the debit side, which means this must be the total on the credit side, and $8,000 here was found as the missing figure by subtracting $4,000 in rent expense from the $12,000. So do not forget to transfer the closing balance at 30 September as the opening balance on 1st of October, which is $8,000. And obviously this is on the debit side because this refers to the asset that we have in the business. So make sure to not forget to transfer, because a lot of students forget to transfer and you will lose marks there if you do not. So let's look into the second transaction that we have. Wages owing on 30 September are $900. So this is referred to wages expense that we have incurred but not paid for cash. This means that this is a current liability of the business, and if we were asked to prepare the balance sheet within the current liabilities section, you have to show this accrued wages of $900. Now, how do we journalize this accrued wages? So we debit wages expense by $900 because expenses are going up, and we credit accrued wages by $900 because current liabilities are going up because we haven't really paid these wages in cash. So let's look into the ledger account that we're given. So we have the wages expense account, and you can see on the debit side, on the 30th of September, we have paid wages of $4,300 using our funds available in the bank account. Then on the 27th of September, the next fortnight, we paid $4,500 again using our funds from the bank account. And we know that on 30 September, we have incurred wages of $900, which we really haven't paid for in cash. And this is a current liability at the moment. So within this ledger account, we record this as accrued wages. All right. So what's the total of all these three numbers? The total of all these three numbers is 9,700. Okay, which is what we have on the debit side. This must be the total on the credit side as well to ensure the fundamental rules of accounting apply. Now, we have to perform a closing entry here. This is because expenses are temporary accounts, and we must reset them back to zero before we start a new period. And this is mainly dependent on the accounting assumption of accrual basis, which calculates profit by subtracting all the expenses incurred from the revenues earned. So before we can start the next period, 1st of October, we have to close any expense and revenue accounts to a profit and loss summary account. So that is how we perform the closing entry. So expenses by default are debited. If you want to close them against the profit and loss summary account, you have to obviously now show that on the credit side. So let's include that. For 30th of September, we're going to transfer the total of wages expense to the profit and loss summary account. And that would be the total amount of 9,700. Okay, we cannot have any opening balance because, as we have discussed earlier, this is a temporary account and is reset to zero. And the only purpose of this temporary accounts is to help us determine an accurate profit figure, which is on a monthly basis for this business. Okay, so let's look into the next transaction that we have, which is transaction number 3. On 20 September, a local basketball club paid $2,200, including GST, for 20 match quality basketballs. Right, so the source document is receipt number 365, which means this was paid for using funds in the bank account. As they were currently not in stock, Big Sports recorded the transaction as unearned sales revenue. 15 basketballs were supplied on 30 September, and the rest will be provided in October. So let's understand what's really happening here. So we have the business, Big Sports, right? And on 24th of September, a basketball club paid us $22,000 for balls that we will supply to them very sooner or later after 24th September. So when we receive this money initially, we have to debit our bank balance by 2,200 to reflect that assets are going up or that money has come in. And at the same time, we know that we didn't really have any basketballs in stock, but we are supposed to supply all these basketballs at a later point in time. So when we want to record the journal entry on 24th September, we cannot record this as sales revenue. We have to record this as unearned sales revenue, which is a current liability. Okay, so you credit unearned sales revenue. All right, and we are doing that by 2,000 because $2,200 includes the GST as well, which means the original price would have been 2,000 and the GST being 10% would be 200. So any GST we collect as a business from our customers is what we owe to the ATO. GST clearing account is a liability account by default, which means any increase in GST clearing, any collections of GST will be shown on the credit side of the GST clearing account because any GST collections increases liability we have with the ATO. So that is why we're crediting GST clearing by 200. Okay, so we understand the journal entry on 24th September. We debit bank by 2,200 because that's what we had received in cash. We are crediting unearned sales revenue of 2,000. This is a current liability. And by default, all liabilities are credited. And that is why we are crediting unearned sales revenue, but by only 2,000, not the GST. GST is to be recorded separately within the GST clearing account and on the credit side by 200 because this represents the GST we collected from customers, and this is what we owe to the ATO. All right. All right. Now we understand that we received $2,000. All right. We have to exclude the GST. Okay. So we are receiving $2,000 for 20 basketballs. So if that is the case, what is the cost per one basketball? So $2,000 divided by 20, or which is not $10, it should be $100, right? So cost of one basketball is $100. So on 30 September, we know that we have supplied 15 basketballs, which means we can confidently say that we have earned the revenue for 15 basketballs. And given that each basketball is priced at $100, this means the revenue that we have earned in total on 30 September is 15 multiplied by 100, which is $1,500. All right. Now, how do we journalize this on 30 September? So we debit unearned sales revenue by 1,500 because our obligation with our customer who has paid us in advance of the 24th of September is now going down. What I mean to say is the unearned sales revenue, which was a current liability account on 24th September, is now being reduced by $1,500 because we have delivered 15 basketballs. And now that the liability is going down, we have to debit it because when liabilities go down, we debit them. And when liabilities go up, we credit them, right? So we debit unearned sales revenue by 1,500 and we credit sales by 1,500, which is referring to the revenue that you have actually earned. All right. And this is to be used as part of your profit calculations, the $1,500 in revenues that you have actually earned because you have delivered the item to your customers. Now, let's look for the treatment within the ledger account for unearned sales revenue. Now, we understand that unearned sales revenue is a current liability account. And liabilities by default should always have an opening balance in the credit side, which we don't really have in this case. But every time you have an unearned sales revenue, it increases your obligation, and therefore the first transaction for unearned sales revenue should be recorded within the credit side. So that is what you can see here. On the 24th of September 2023, we received the funds into a bank account from the local basketball club of $2,000, obviously excluding GST. And then you know that on 30 September, you have delivered $1,500 worth of items, which you can confidently say as proper revenues that you have earned. And after you have got that, we determine the closing balance of 500 because obviously on the credit side, you can see that we only have 2,000, which we have brought down here. And this must be the total of everything on the debit side, And once you subtract 1,500 from 2,000, you are left with the closing balance at 30 September of 500 for unearned sales revenue. This is referring to items that haven't been supplied yet, which are 5 items, right? Because each item is priced at $100. This balance must be carried forward as the opening balance on the 1st of October. So do not forget that. And that is $500, right? And this opening balance is to be shown within the credit side because obviously this is still a liability. All right. So let's look into transaction number 4. The delivery van with a carrying value of $30,000 on 1 September is depreciated at a rate of 24% per annum using the reducing balance method of depreciation. So we're working with a non-current asset, a delivery van, which has a carrying amount of $30,000 on 1st of September. So this carrying amount of $30,000 refers to the economic benefit that is available within this delivery van for use within the business. Now, we are using the reducing balance method. And when we are using the reducing balance method, if we want to calculate the depreciation on an annual basis for an asset that has been already in use within the business, we multiply the given percentage of the rate with the carrying amount. So the given percentage is 24%, which is an annualized rate. The question explicitly mentions 24% per annum. And that is what we are multiplying with the carrying amount of $30,000. And that gives us $7,200 as the depreciation on an annual basis. So on an annual basis, I meant to say that $7,200 is valid for 12 months. And because we are working with the business, which reports on a monthly basis, we want to find that depreciation on a monthly basis by simply dividing 7,200 with 12, which is $600. So if you were to journalize this as a balance day adjustment, you would debit depreciation of van by 600, which refers to expenses incurred by the business through the consumption of the economic benefit that comes with the non-current asset, the delivery van. And then we credit accumulated depreciation of van by 600 because this is a contra asset account which records the reduction in economic benefit of another asset, of the relevant asset, which in this case is the delivery van. So how do we record this within the ledger? Pretty straightforward. So depreciation of delivery van is an expense account. We understand that. And all expenses, all transactions relevant to expenses have to be recorded within the debit side. So on the 30th of September 2023, within the debit side, we're recording accumulated depreciation of van by 600. Now, this is an expense account, right? And under the accrual basis assumption, we calculate profit based on the revenues earned minus the expenses incurred. And because this is an expense account, this is a temporary account, and we know the business reports on a monthly basis. Therefore, we have to close this expense account, which is a temporary account. We have to close it against the profit and loss summary account, right? So how do we close it against the profit and loss summary account? Very easy. So just simply transfer whatever expense amount you have incurred for depreciation to the profit and loss summary account by closing it on the credit side, as you can see we are doing now. Okay, and that's all what you have to do. Every time you have revenues and expenses, you need to close it. You might wonder, why didn't we close unearned sales revenue? It's a revenue account, right? No, it's not a revenue account. It's a current liability account. Liabilities, assets, and equity are not closed to zero. They're always carried forward to the next period because the assumption is there that they're there to sustain the business operations and finance the business activities. Okay? All right. So closing entry definitely needs to be done. And that's how you get full marks. So what about the last transaction we have? And allowance for doubtful debts was estimated to be 5% of net credit sales. In September, credit sales totaled $81,000 and sales returns were $1,000. All right. Now, let's first calculate the net credit sales. Now, the net credit sales is simply calculated by taking the credit sales of $81,000 and then subtracting the sales returns of $1,000, which gives us $80,000 in total. Now, if I want to find the allowance for doubtful debts, which refers to so this is a contra asset account where we keep some amount aside for possible bad debts that the business will incur or are expected to incur. All right. So allowance for doubtful debts is calculated by applying 5% with the net credit sales of 80,000, which is 4,000. Okay. So this $4,000 is the closing balance for allowance for doubtful debts on 30 September. So let's see the treatment within the ledger account for allowance for doubtful debts. So we understand allowance for doubtful debts is a contra asset account. Contra asset account tracks the reduction in another relevant account, which in this case would be the trade receivables, the credit customers of the business. So contra asset account should have an opening balance on the credit side always, which is what you can see on the 1st of September. And the opening balance is given to us as 1,700. Based on our calculations, we have found the closing balance on 30th of September, which is obviously on the debt side, to be $4,000. All right. So we understand that during the month, we had an increase in allowance for doubtful debts of 2,300, which was simply calculated through the difference we get from 4,000 and 1,700, right? And this 2,300, which is the increase in allowance for doubtful debts, is mainly the bad debts we have expensed or incurred during this month. So if I was to generalize this, I would debit bad debts by $2,300 and I would credit allowance for doubtful debts by $2,300. So within the ledger account for allowance for doubtful debts on the credit side, you can see on the 30th of September, I have included $2,300 in excess that we have incurred during the month, and that excess was incurred due to bad debts. All right. So altogether, we have $4,000 as the grand total on both sides. Now, again, do not forget to transfer the closing balance as the opening balance on 1st of October, and that is $4,000. All right. Okay, so let's look into the discussion question. With reference to an accounting assumption, explain your treatment of one of the balance sheet adjustments. I believe we have already been discussing this throughout the question as we went from one transaction to another. But let me walk you through this again. So we are using the accrual basis assumption. We understand that. And the accrual basis assumption calculates profit by taking the revenues earned and then subtracting the expenses incurred. All right. And this is done as part of the balance sheet adjustments because we want to reset the balances for revenues earned and expenses incurred to zero for the purpose of calculating profit prior to starting the next accounting period. Then we have the period assumption or the reporting period principle, which calculates the profit for a business on a periodic basis. And at the moment, we're talking about a business which reports on a monthly basis. Okay. So every time a month ends, the business wants to find out the profit, and that helps the business make better decisions and understanding how to do better in the next financial month. So explain your treatment of one of the balance sheet adjustments. So maybe let's start with the first one. So based on the first transaction, we had our prepaid rent, all right? So we know this is prepaid because we paid this on the 15th of August. And we prepaid this, including GST, 30,200, which is 12,000 excluding GST. And we understand that this $12,000 covers the 3 months of September, October, and November. We're preparing the balance sheet adjustments for this business on 30 September, which means 1 month has already passed. So if 1 month has passed, it means that we have expensed 1 month of rent, or we have consumed the economic benefits that comes from the prepaid rent. So the value of expense for 1 month of rent is $4,000, which is simply calculated by dividing $12,000 paid for 3 months by 3. Okay? And we did the journal entry and we understand that we are debiting rent expense by $4,000, which is increasing the total expenses for the business and therefore reduces the profit. And then we credit prepaid rent expense by $4,000, which reflects the economic benefit that we had within this current asset originally, and now we have to reduce it. So this is what you have to discuss in terms of the treatment of the balance sheet adjustments. Let's look into another one. Let's look into transaction number 3. So in transaction number 3, what we had was an unearned sales revenue initially. And what happened was on the 24th of September, we received $2,200 from a local basketball club. So when we received $2,200, we obviously recorded this as an increase in our assets, in our business, which is mainly the bank account. And then we also recorded this as a liability, a current liability, which is unearned sales revenue by $2,000. Okay. We know that on 30 September, we have delivered 15 basketballs. And based on our calculations, we found that the price of one basketball is $100. So if we delivered 15 basketballs on the 30th of September, this means that we have actually earned revenues worth $1,500, which is simply calculated by multiplying 15 with 100. Okay? And when we have earned this revenue of $1,500, what's happening? The previous obligation of current liability we recorded in the books on 24 September of $2,000 will now need to be reduced by $1,500 because we have delivered our products to our customers. So if we reduce the obligation of the current liability, we have to do the opposite of what we normally do when we increase it, which is credit it. So if we have to do the opposite, in this case, we have to debit it. So we debit unearned sales revenue by $1,500. And then we recognize the sales, and every time you recognize sales or you have earned sales, you increase it, and you increase it by crediting the sales revenue account, which is $1,500 in this case. So when you credit the sales revenue account by $1,500, your profit goes up, right? And then when you debit unearned sales revenue by $1,500, your current liabilities go down. So I believe you can easily score full marks in this question. And I believe a lot of students would have got full marks in this question during the original exam period last year. So that's all for today's lesson. I believe you found a lot of value in this content. Make sure to like this video and subscribe to this channel. And if you need tutoring sessions, check the link in the description to book a call with me and discuss your requirements. I'll see you in the next video.